It's been a little while since I've had an email of the week that's been worth commenting upon. Most unfortunately have simply been too stupid or too inane to be worth the effort. However, I got an email earlier this morning that did prompt me to do some thinking about this topic in particular. The concern, as you would imagine, is the current state of the market and what can be done. More importantly, the tone of the emails in particular suggest more along the lines of what can be done in the past. Well, unfortunately, now is not the time to think about learning how to swim. And I say they take on the tone of what can be done in the past because they are backward looking. They are looking back at what they should have done. The unfortunate thing is that time has passed, and generally anything people try and do now as a panic measure tends to make matters much, much worse. As to when one should decide when to learn to swim, well, that's actually really quite easy. It's when the market's going up. That's when you decide that you should have in place some mechanism that tells you when the market has stopped going up, and by extension of that, that there is action that you need to take to protect the value of your investment. The unfortunate thing is that the majority of investors suffer from an issue known as recency bias, which I've spoken about before. And it can be simply summarized as, today was like yesterday, therefore tomorrow will be like today, and that pattern will never change. This is a sign of inexperience and naivety. It's also a sign of not being a student of the market. And if you are not a student of the market, then you're really not serious and probably have no business in markets at all. You certainly don't want to be thinking about capital preservation strategies at the 2 points I've highlighted here. The first one is the GFC. The second is COVID-19. These are not the times to be suddenly deciding what you should or should not have done, because it's simply too late. The damage has been done. All you will do is make it worse. And this is not a dismissive statement, a statement from on high. It is simply a recollection of the notion that history repeats itself over and over again. And if you're involved in markets, you should, in some way, shape or form, be cognizant of that as an issue. As an example, this is a chart of the South Seas bubble. You'll notice that this crash occurred in 1720, some 300 years ago. The astute in you will also notice it looks a lot like Bitcoin, because it was the Bitcoin of the day. It was the scam of the day. You will also notice it conforms to the very generic rule of all booms end in busts. That's a universal law. There are very, very few universal laws in trading, but that is one that has stood the test of time. To put this into further context, these are simply the events that I've encountered since beginning in this business. Each one of these proved a shock to the market. Therefore, there is simply no excuse for not having a mechanism in your portfolio that says, when I run into outlier events, I will take the following action. The problem at present is people are looking at the end of the world and are attempting to make a rule for the end of the world. So literally they're writing down in their plan, in the event of a global pandemic, I will do A, B and C. Well, for a start, it's probably highly unlikely we will see another global pandemic of this size. The second is there's no need for it. Your trading or investing plan should already have in place a mechanism that says, in the event of prices falling by a given amount, I will take the following action. It doesn't need a trigger statement. It doesn't need a statement that says, in the event of X, I will do Y. That's simply pointless and redundant. It is also in no way reflective of reality. But some of the tones of the emails I've been getting have been mentioning one word in particular. And that one word in particular is hedge. Now, I do not know whether there is a spruiker out there doing the rounds saying that if you had hedged your portfolio using options, you would not have suffered at all during the market breakdown. Okay, first point about that, bullshit. That's not how hedges work. And in relation to hedges, there's a few points that need to be made. The first is, when do you hedge? This is the S&P 500 index, over which I've just thrown a moving average. Do you hedge each time price penetrates the moving average? Well, if you hedge, then it's too late. And it's too late because if you're hedging using options, the price of your hedge is already inflated to a point where it's simply not worthwhile. Do you hedge when you think the market is topping? Well, you might have thought the market was topping in 2012, 13, 14, 15, 16, 17, 18, 19. And you would have been wrong on every occasion. The second point about hedging is it costs. It is not free. Hedging is often advertised as this get-out-of-jail-free card that literally says you will not participate in any of the losses that the market might generate, but you will participate in all the gains. That's not how this game works. Everything extracts a cost. For example, let's assume you're hedging an instrument, a bank, and you're doing it once every quarter. That hedge will probably cost you 2% per quarter. That's 8% per annum. So if your investment in this particular vehicle is returning 16% per annum, you've just given half away. Let's perform a little thought experiment. Let's assume that we have $100,000. It's invested either in a single instrument or the portfolio returning 16% per annum. We have a 20-year time horizon, and we compound our investment once a year. You can see that our terminal value of our investment is just under 1.95 million. The experiment, but assume that we've hedged, and the hedge has eaten into our returns by halving them each year. And our return is $466,000. You'll notice that's not half. And it's not half because that's the way compounding works. Every time you impose a small bit of friction into the system, you crank or ratchet down the long-term performance of the portfolio when you look at it as a compounding instrument. This is the central issue regarding hedging. Not only is it what seems to be small impost today, it's an extremely large impost on the future, because that is simply the way hedging works. However, there is a very, very simple no-cost mechanism for dealing with these sorts of market events. It's incredibly unsophisticated, incredibly simple, and almost impossible for the majority of investors to use. It's called a stop. This is simply a national bank with a 3 and a bit ATR stop plotted on it. And you can see, intriguingly, that national banks started to fall in November. If you had exited then, you would have exited somewhere around the $27 mark. Given that the stock is now $16, that actually looks pretty good. This costs you nothing other than the emotional discipline to enact it as a strategy. And therein lies the difficulty. Most people lack the emotional courage to enact stops because they don't want to miss out. The notion of a hedge is appealing because it supplants this notion of missing out with the nonsensical idea that you're completely protected against the downside, but you'll get all the upside. As we've seen, that's rubbish. That's not how the world works. In trading, there are no free rides. But this harks back to a bigger notion, and it is the notion upon which people build their investment portfolios, their trading plans, their speculative ideas. Most build them based upon the wrong ideas. Yet intriguingly, the three underpinnings of successful investing or trading are immensely simple. You buy when the market is trending up. So we go back to our notion of when the S&P 500 was trending up for the decade post the GFC, we are a buyer. But inherent within that notion is the second point. We sell when the market is trending down. That means by definition we have a mechanism of telling when the market is trending down. By definition we have stops. But the most intriguing part about these rules is really quite simple. It's the final rule. None of this is rocket science. None of trading is overly complex. In terms of the statements that guide it, the principles that guide it, it is immensely simple. But it is also extraordinarily difficult for humans to enact. And it is difficult for humans to enact because it is very, very difficult for most people to get out of their own way and to realize that the great impediment they have is not the broker, it's not the market, it's not what they watch on the business channels. It's actually themselves. And no amount of fancy strategy will compensate for that failing.